comparisons to the 1930s biggest pullback, snapback rally since 28-32, but otherwise we're in a bear market. Others say no, it was the bottom. What say you?
Yeah, right. It's a U-shape, V-shape. What is it? And I think the safe answer has been U-shape. If you listen to most strategists right now, the big question isn't the magnitude's going to be bad. We know it's going to be bad. Every day the news is terrible, but the question is how long does it take us to get back to work?
What's up guys, Ben here and welcome to Motivation to Invest. The global health crisis caused the whole planet to be put into lockdown and the economy to be halted. The real question on everyone's lips is how long will it take for the economy to recover? Now during the first part of this pandemic, in early March, April 2020, there was a lot of talk of a V-shaped recovery. That is fast in, fast out.
That a V-shape is very, very possible here. I mean, we have the mother of fiscal and monetary stimulus right now, Brian, coming into the economy, and I have to think some of that money's going to end up in the stock market.
However, since then, the talk of that V-shape has been put into question, as many people have spoke of a possible second wave. So who's right? Well, in this video, we're going to find out as I pitch up a battle of the great economists. Let's dive in. Welcome back guys to Motivation to Invest. Before we get started, it would really mean a lot to me if you give this video a big thumbs up. That really helps out with the YouTube algorithm, which allows me to create more great content like this for you guys. In addition, if you want more investing tips and exclusive stock picks, which I personally am investing into, then you should definitely subscribe to this channel and turn that notification bell on. With that being said, let's get into the video. A notable figure is the great economist Gary Shilling, who is most famous for predicting many of the previous stock market crashes, such as the 2008 housing bubble.
Well, I'm known for looking for bubbles.
Oh, I think we're headed for a recession.
I think that housing is going to see a substantial price decline.
Housing is starting to fall apart.
I've had reasonably good luck in spotting him. I was probably the only economist on Wall Street who saw the big inventory build up in the early 70s that led to the 73-75 recession, which up to that time was the most severe on record. I've been known probably the best for having said in 1981, we're entering the bond rally of a lifetime when Treasury bond yielded 14.6%, the 30-year bond. Well, I also was pretty lucky in the housing bubble. Starting in 2002, we saw what we thought was an emerging bubble and followed it on up and then correctly forecast the demise. And incidentally, it paid off very handsomely for me and my clients. You don't add any value by rehashing the consensus. That's already discounted. It's fully worked into markets.
What do you see as the path forward for the economy right now?
I think what we're looking at here is really an L. It's declining. It's not the V. It's not a recovery in the second half. It's a continuing on down into 2021, and thereafter probably a relatively slow recovery.
What are some of the factors that will affect that shape of the recovery, so the L shape that you're referring to?
I've got a list of about 10 of them, but I think we're going to see a lot more people doing what we're doing, working from home. They're getting used to it. Commuting is not all that much fun. I think we're going to see a change in consumer spending habits. People are going to be a lot more cautious in terms of their spending as they go ahead. I think we're going to see downward pressure on prices. And that works to the advantage of Treasury bonds, which have been my favorite since 1981 when I said we're entering the bond rally of a lifetime. And by the way, since then, long-term Treasury bonds have outperformed the S&P by six times. And I think we have even lower rates because of the safe haven effect and possible deflation.
So it sounds like you see a lot of real structural changes resulting from this pandemic, not just short-term changes. These are big picture, long-term changes in how we spend our money or how businesses operate or how governments operate.
Absolutely. I think that's where we are. Let's say you look at this versus the subprime mortgage collapse. Now that was the deepest since the Depression of the 1930s, but it only affected directly a relatively few people. Now it spread throughout the economy, but it was only those people who were speculating in housing who really got nailed. This one affects everybody. I mean, we're all basically combined. I mean, you're not in your office. I'm not in my office. Very few people are. The opening up is slower. Obviously, the politicians want to open up quickly to get the economy back on track. That's true of governors. It's true of the president. But the populace are sitting there and say, "Hey, why should I risk COVID-19 and possible death?" So it is extremely disruptive.
Your mid-year outlook for economies, Joyce, is it a bit more positive or less positive than it was, 2 or 3 months ago?
It's definitely more positive over a 1 to 2 month view than it was a few months ago. The labor numbers, the employment numbers have been better. And what we're seeing is, we had a synchronized downturn. So we're seeing at least the partial V shape back up. But I think the 3 to 6 month horizon is really more of the question that we're looking at and that we posed in our mid-year outlook. We still see GDP almost 4% below where it was pre-pandemic at the end of the year. But you still have fiscal support coming online. The income support is still there. That will begin to roll off in the fourth quarter of the year. But over the next 1 to 2 months, what the data is telling us, and we're looking at a lot of high frequency data, is that the numbers are going to remain pretty strong, on this V-shaped rebound on the consumer spending side. So I think you could still have a little bit more momentum here, but watch out for the fourth quarter. Over the next 1 to 2 months, I think you could see VIX actually come down more from here. You can also see that there have been, a few more surprises, as far as the GDP growth numbers. And, China's been leading some of that. We have seen there that China looks to be almost close to a full recovery.
Joyce, I'm absolutely fascinated how M&A types rationalize the acquisition of a 28 multiple, 4% revenue growing company, or maybe a 32 multiple as well. I mean, stocks are fully priced in many sectors, okay, fine, and yet we're all talking about M&A activity because money costs nothing. How does a CFO rationalize the acquisition of a 28 multiple PE?
Well, I think you're absolutely right. Money costs nothing. So if you take a look at just how corporates can raise debt, now you've got, on the one hand, on the corporate side, the default rate has been rising. It's over 6% in the high yield market. That's a 10-year high. But you also have that you're going to see all-time record issuance in the U.S. corporate bond market, $1.6 trillion. So there have been downgrades. I mean, we've seen 11% of U.S. corporate high-grade debt downgraded just since the beginning of the year. But you also have that companies are able to come to market and they're trying to plan ahead for the longer term. And I think that's what the market has been focused on, is that, is this period, they're trying to put a buffer into place right now.
Where do you think the most fundamental scarring will be?
I think that you will see that unemployment still, we were at a 50-year low. The unemployment numbers have surprised, but are you still going to see unemployment at close to double-digit levels? And that then relates to where is private labor income, unemployment. You also will see more downgrades going to junk status. We see about $300 billion of BBB minus debt is still on negative outlook, and that's after having already $160 billion downgraded already. So there are longer term consequences for this. But over the next 1 to 2 months, what the market is assuming is a couple of things, that the second wave will be there, but you're not going to go back to the lockdowns that we had. They're assuming that the accommodative stance and more stimulus is here, at least over the short term. But you will have in the fourth quarter more concerns about the U.S. election outlooks, more concerns about whether they have to extend this income support or what happens when it does roll off. But for the time being, what you see is that corporates see a real point to take advantage of coming to the market at spreads that are really close to all-time lows, and that what you're seeing in the equity markets too is that there's still positioning that's relatively supportive. Positioning is probably at the 25th to 30th percentile right now, and that's also one thing that is propelling the market.
So when do you think the economy will recover? Are we set for a V shape or an L shape? Let me know in the comments below and I'll join in the discussion. In addition, if you enjoyed this video, go ahead, smash that like button for the YouTube algorithm. And if you'd like more stock market investing tips, and exclusive stock picks, which I personally have invested into, then you should definitely subscribe to this channel. And with that being said, I will see you guys on the next video. Invest safe.